Dear investors, wishing you all a very happy and prosperous 2023. Today, we will look at what really worked from an equity market perspective in 2022, and then what are the sectors that look promising for 2023, and how do you construct your equity allocation going into next year. So, if you look at overall, India relatively outperformed the global equity markets. It gave better returns than the world, the US equity markets, and even emerging markets. So we were around close to 5.5%, 6% positive returns on the top line indices versus Dow Jones, which was minus 6.8, S&P 500, which was minus 18, MSCI Emerging Markets Index, which was minus 19. And even the MSCI World Index, the aggregate equity markets, was minus 17.7. So we had a significant outperformance last year. And if you look at in our market, large caps outperform mid and small caps. So this is a trend that we have been seeing work in equity markets, and we think that this trend is likely to continue. The shocks of demon, COVID, and GST all combined, we saw that large caps have gained market share, and therefore that trend may well continue over the next year. From a sector perspective, what worked, what was positive was power, oil and gas, banks, autos, FMCG, capital goods, and metals all did well last year. On the negative side were sectors like IT, healthcare, consumer durables, and real estate. These sectors were laggards last year. So in 2022, we saw change in economic scenario from a loose monetary backdrop to a tightening interest rate scenario. As cost of borrowing increased and inflationary pressures that impacted companies, we saw growth and quality underperform while value outperformed. So it was a turn when value revived and value style did really well. Getting into 2023, the macroeconomic backdrop is unlikely to change materially, and monetary authorities will continue to remain restrictive for some more time. So with India growth slowing down a bit, but holding relatively well as compared to other economies, India should relatively be well placed. So in such kind of scenario, what are the top three sectors that are relatively better placed for 2023? The first sector is autos, especially two-wheelers. So auto volumes are trending below the levels prevailing in 2019. Driven by subdued two-wheeler volumes. As we have seen that input cost moderate, price hikes could moderate from here on, translating to better affordability for the average consumer. And therefore, we expect volume to pick up over the medium term. Valuations are also quite compelling with decent payouts. Replacement cycle playing out will also boost demand. The need for mobility, as say example, IT sector shifts from a hybrid model to a hybrid model would also spur the demand. Today, we are in transition from a work from home to a hybrid model per se. And if there is a rural recovery that takes place, like for example, if you have moderating inflation, good harvest, policymakers focusing on boosting rural incomes to run up in the run up to elections. So all those would bode well for rural recovery and could drive the two-wheeler demand per se from rural regions. So overall, autos, particularly two-wheelers, look attractive. The second sector that looks promising is the BFSI sector, the financials, banking and financial services. So they are beneficiaries of credit growth and NIMS expansion and low credit cost in the recent past, though it's been inching higher. So incrementally, while there can be some normalization as deposit rates catch up, banks, NBFCs look well poised to capture cyclical upturn in the economy. Despite recent run-up that we've seen in that sector, it was one of the leading sectors last year. Valuations within this sector are still in line with historical averages. So it's not that the run-up has made them really expensive. So from valuation comfort, there is still room for it to move higher. And coming to the third sector, which is IT services. IT services also went through a bad phase around 2017. We find them, similar kind of pessimism surrounding growth of that sector currently as well. So after a tough CY22, there is easing of supply side in attrition rates, which would benefit margins. Near-term risk of global recession and slower exports are already priced in. Indian IT services cater more to maintenance, which will limit impact of a global slowdown if that were to materialize in an extreme scenario. Global economic slowdown could accelerate cost takeout deals where Indian IT companies are beneficiaries. And given the valuation correction that we have seen over the last year and potential for market share gains, we find Indian IT services quite attractive currently. So, with that sectoral outlook, I think quantum equity portfolios are well placed with adequate exposure to benefit from these sectors. Also, as an allocation, one should have a high allocation to equities from one's portfolio to benefit from the inflation beating returns that this asset class delivers over the long run. So, as a portfolio construct, you should have a higher allocation to equities, like in the 12-20-80, we recommend 80% allocation to equities. Similarly, one should, the core of your portfolio, the larger chunk of the allocation should be in equities. So how do you, if you don't have adequate exposure, how do you build that? So 2023 may also be a volatile year, at least for the first 6 months. And hence one can build up their allocation gradually to this asset class over the course of next year. And this allocation needs to be very well diversified across styles. A larger allocation to a diversified allocation like quantum equity fund of funds, which is a basket of various equity funds, and a smaller yet meaningful allocation to styles like value and ESG could complement and complete the allocation to different styles, because you don't know when which style will be in favor. Like we saw value come back last year. Therefore, different market scenarios, different styles may do well. And therefore, you need to have a diversification across different styles of equity investing. So with that, I wish you a very happy 2023 once again, and we hope you have a fruitful year, and we hope that you build a sensible allocation through the 12-20-80 kind of allocation, and build your portfolio to reap benefits over the long run. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.